Hey guys, Joe Wehbe here, Managing Director of Sydney Listings, talking today about the difference between investment properties in capital cities like Sydney and Melbourne versus regional investment properties. Okay, a lot of the time they're cheaper, but let's talk about the differences and what factors you need to consider when weighing up where you're going to be investing. And this is kind of inspired by a lot of other young people I know, my age, who are starting to look to invest in property and thinking about investing in their hometown. Some people from regional areas or in cheaper areas where they can afford, when they can't afford more premium properties. So let's break it down. So the appeal with, I guess, your capital cities and why we do tend to focus on them is that there's, for cities like Sydney and Melbourne, right, there's a lot of international migration always happening in these places, right? There's population growth projected, with reasonably good predictability into the future, which means more demand, okay? And then depending on where supply levels go, in general, that demand will be absorbed, and that's what delivers, a value increase in the value of a property. Whereas you don't necessarily get the same effect trickling into regional areas, right? It's not the same consistent supply of population growth, but there are other factors that can be at play, all right? So capital cities in general have higher values, right? So they can be harder to buy into, and then they normally have compressed yields, which means that the rent in relation to the value of the property will be lower. Whereas in regional areas, you tend to find higher yields, so the rent will be a lot higher. You might have a better chance of the property being, positively cash flowed for you, which means that all the expenses are met on the property and then there's some left over. Whereas that is a lot rarer to find in capital cities, and a lot of the time people need to supplement their income week to week to meet those expenses like mortgage repayments and any other management fees or expenses associated with the property. So those are the differences between how those properties tend to perform, right? Your capital cities are more robust because that picture doesn't change much over time. It's very consistent. Obviously there are cycles in these cities, but if you have a long-term perspective, it's less important when you necessarily enter, because that'll make a subtle difference when you look at what that property might be worth in 20 years, 30 years, provided you're able to afford it for that period of time. Okay? If you can't afford to hold it, you have to sell out early, it doesn't necessarily make that much sense. And that's why you might look at, properties in regional areas. They may not have that same capital growth trajectory, but you do need to be more delicate about your timing in those markets to make the most of a capital growth trajectory. So if you're picking things at the bottom of the cycle before things are trending back up, that's obviously your most ideal time to get in, especially when you look at those superior yields can be very attractive to people who might not be on the higher incomes and can afford to buy inner city properties in Sydney, right? Again, if you have to sell out of a more expensive property, you're not really realizing that full value, okay, in a capital city. So that's when it pays to look at where you can afford and making sure things work, because the best value you're going to get is a property that you can hold for a long time, comfortably, not cause you financial stress, not cause you any other kind of stress. So it can be helpful to talk to professionals like certified property advisors or other investment savvy professionals related to property, agents, mortgage brokers, accountants, financial planners. Those are the sort of people that can help you and point you in the right direction, because ultimately the numbers are going to dictate what you can afford to hold, what you can afford to buy, what your buying power is, and then you can basically unpack a strategy around that. So if anything's unclear or you'd like to know more, feel free to reach out. We've got abundance of resources or resources we can point you in the way of, and look out for any and more videos we have on this subject and anything related to investment. Thank you.